Good morning, clients and dealers and remisers. Welcome to the first morning call of the year. And today we're going to update our equity market calls a little bit. Okay, the broad call remains the same. We're still overweight on stocks, neutral to underweight bonds, neutral commodities, and underweight gold. Okay, this is the broad call for 2014. In terms of equity market calls, we're actually going to downgrade the US from an overweight to a neutral. Although macro conditions are good and suggest a continued bull market, we actually find that the S&P 500 is ripe for profit taking on contrarian indicators. So you know the US has had a 30% run for 2013 already. The indices is looking stretched, and valuations are not high but fair. So they're not here. It's not cheap. It's not expensive, and we actually think that a lot of 2014 is pretty much priced in. So we see that although we're not going to say that the S&P 500 is going to go into a bear market, I think it's far from that. I think a significant correction is probably on the cards at some point. And given that we still think that the outlook for the US is positive, that correction could be a buying opportunity. But till then, we're going to neutral weight in the US. Now, China is a continued overweight, but with risk, it's been a bit of a disappointment. We have been bullish on China, but the index has not reacted in the way that we hoped. The economy is holding steady and is rebalancing in the way that the Chinese government wants it to, in terms of what greater proportion of the economy for services rather than manufacturing and industrial production. That is happening. Corporate profits are also rising. Reform is in the air, as we have gone through before. Valuations are rock bottom cheap, but the CSI 300 is just unable to take advantage of that. And I think we have to acknowledge that the macro risk of the local government debt is casting a very long shadow. For Thailand, it's a neutral. Political risk is having a negative effect on both the economy and stock market sentiment, and it's becoming more apparent that a democratic solution to Thailand's political woes is getting more remote. This represents a bit of a risk for the region. There's very little visibility on what might happen, except to say that our colleagues in Thailand are predicting that the military will have to intervene at some point. Indonesia is neutral but with upside risk. Actually, the current account deficit in Indonesia is starting to narrow as the weak rupiah is boosting exports and cutting imports. Things actually could be looking up. But again, 2014 is a presidential election year, and it could entail that portfolio managers will remain cautious on Indonesia despite improving macro fundamentals. Thus, we don't think that there's we think that most investment managers will wait on the sidelines for Indonesia. So while we don't think that it's going to go down much more, there is, I think, most managers will wait till after the elections before they start buying again. Malaysia is a upgrade from neutral to overweight. The economy is a standout in Asia with both external and domestic drivers. On the external front, G3 economies are picking up, and on the domestic front, there is quite significant public and private investment drivers going on, including the Iskandar region. The fiscal position is also now under control, and so there are more tailwinds than headwinds for Malaysia. Singapore remains an overweight. Economy should benefit from a G3 pickup, just like Malaysia would benefit. The STI is very cheap at 13 times PE, which is a discount to ASEAN and DMs, which are trading in the slightly over the mid-teens. Singapore is also a safe haven, and amid this macro and political uncertainties in Asia, and it could outperform for 2014 as portfolios would buy the STI for Asia allocation. Right, and for our market, we favor industrials and financials. On the industrials, we have top picks Keppel and Bousted. Financials, we have top picks DBS. And right now, I will pass you on to Kenneth.
Okay, thanks, Joshua. Here's Kenneth. Okay, here's the market technical outlook for this week. Okay, pardon the wordy slide for the S&P 500. Okay, but let's get through this. Okay, essentially, technically speaking, the S&P 500 is still on a strong uptrend. It has been on an uptrend, okay, but we do recognize that short-term it is extended. Later on, we'll talk about historically there are odds that we're going to have a meaningful correction sometime this year. As Joshua pointed out, because of healthy fundamentals, we don't think the correction will morph into a bear market, but the odds are there will probably be a correction this year. Okay, seasonality-wise, if there is a correction, the likely periods would be either February or May to September. Okay, so anyway, fundamentals suggest that meaningful corrections, if they should occur, should be bought. Okay, so in terms of a bull run, this is definitely a confirmed bull run with the Dow, Nasdaq, and S&P all hitting new highs. Okay, there is no major top in sight yet. Usually, major tops take months to form. Okay, and we'd like to see a pattern forming at least, and the pattern could be in the form of a lower peak, a double top, or head and shoulders pattern. Okay, we don't have that at all, and it usually takes a few months to form. So you can say the bull market is still pretty strong. However, we do note that the S&P 500 has not seen a 10% correction since the second quarter of 2012. So odds are we'll see a decent correction this year. Now, minor divergences in the Russell S&P. As you can see, as the S&P has gone up in price, we have a divergence in the Russell to S&P ratio. Okay, now the Russell are more sensitive small cap stocks, so the fact that they are actually not confirming the move of the S&P may hint of a correction to come. Okay, breadth indicator, the SPX AR50 also hints the same thing. Okay, our price goes up, but the breadth indicator has not improved. Okay, however, sector rotation wise, offensive sectors are still leading the way. All right, so this tells us again that we're probably still in the middle bull to late bull phase of the bear run, and any correction, meaningful correction, will probably be considered buying opportunity. Okay, but at this present moment, the reward to risk price is not fantastic. Valuations are not cheap. Now, on a shorter term, right, there could be a potential down cycle. We do have a bearish candle recently, last week. Okay, following which the MACD is turning, but hasn't crossed yet. At the same time, the McLaren oscillator is dropping. It has not gone below zero yet. Okay, but essentially, when it does go below zero, this means that the number of stocks that are decreasing has increased to negative territory. Okay, usually is a confirmation of a down cycle. Okay, so a down cycle might be in the cards. Now, if there's a down cycle, then we peg this blue zone as a support zone, immediate support zone. Okay, price should enter here if there's a down cycle. Okay, let's talk about sentiment. So the sentiment right now in the US, at least, is actually quite euphoric. Now, this is the investors' intelligence bulls and bears. It marks basically the ratio of bullish versus bearish sentiment. It is based on a survey of numerous financial analysts slash funds, and the survey is to basically interview them, ask them whether they have a bullish or bearish stance. So as of right now, the bullish to bear ratio, the bull's bear ratio is 4.23. It's higher than 4, which is actually very high. So for every one bearish sentiment, there is 4 bullish sentiments. Now that's very high. So why is this significant? Okay, essentially, if you look at all the times in the recent history that this sentiment has gone past 3 or higher, you'll see this pattern here. So this is the chart of the S&P itself. Okay, and the red lines are when the bull bear ratio has been 3 or more, and we see that essentially in the past 10 years, every single time that this has happened, it usually precedes some sort of correction. Okay, it could be a minor one, could be a major one, could be a start of a bear market, but 90% of the time it does it does precede some sort of sell down. So that's what we have as of right now. So this is one reason why we think that the index could be a bit toppish, it could be a bit overbought. Okay, just for your reference, when the Bulwer ratio is less than 1, that also seems to be a good intermediate buying opportunity. As you can see, every time this is less than 1, okay, even in a bear market, right, when this is less than 1, it still precedes intermediate move up, which can be quite high. Okay, in the in the bear market, you have this in the bear market, the bounce can be quite high. In the bull market, this leads to a great entry point for continuation of the bull run itself. Okay, so let's talk about historical perspective. No, so we noted that sentiment seems to be towards the overbought side. Okay, right, we are right for a correction. So if we are right for a correction, when could the correction happen? Okay, before that, another reason why there's a high probability of a meaningful correction this year is also the presidential cycle. Okay, what does this mean? Okay, essentially, in the presidential cycle is 4-year term, and just historically in a 4-year term, the first 2 years of a presidential cycle is usually the weak years. The year 3 and year 4 is stronger years. So last year was the start of the presidential cycle. So since year 1 and 2 are supposed to be the weaker years, but note that last year was actually a strong year for the US. So just by this probability, the odds of a correction in the second year is actually pretty high because last year was strong. Okay, so a 4-year cycle low seems to be due in 2014. So based on presidential cycles, the probability of of this year having a correction is also pretty high. Okay, so based on this, based on investor intelligence, I think probabilistic wise, the odds of a sell down this year is pretty high. Okay, now if it does happen, then just looking at seasonality, we just want to note that until we have further visibility, we can just use this as a guideline. So historically, for the Russell, the small cap index, February is seasonally the weaker month, and followed by July, August, September. Okay, these are the next weakest months. Now for the S&P is similar. January is flat, February is weak. Okay, then May, June onwards to September are the weaker months. Okay, so this is just used as a guideline until we have further visibility on the price chart itself. This is just a reference for us to use. Okay, so February, maybe a weak month, followed by May onwards. Okay, intermarket and sector analysis. Just a recap on this. So we note that the US Treasuries, right, on the top chart here, they have confirmed their downtrend. So we've been bearish on bonds since the middle of last year. And so this is basically a confirmation of the downtrend that we thought the bonds would be going through. For the Dow Jones World Index, stocks are continuing their stock cycle. Okay, of course, a correction wouldn't surprise us, but it's still bullish. The commodities is still consolidating and has not broken out yet, and this is actually good for stocks. Okay, because this means that inflation is not a concern yet. So taken together, this verifies where we are, stage 4. So finally, we do note that bonds has a confirmed downtrend. Okay, commodities have not topped out yet, and stocks are still in the midst of its bull run. So we reiterate that we still believe in phase 4 of the stock cycle. Sector glances just corroborate this. This is a yearly chart, so 1 year, and we note that cyclicals have been consistently outperforming the S&P. Industrials, same story. Okay, materials is starting to turn up. Okay, energy is still flat, has not turned up really yet. Okay, and of course your utilities, your defensive sectors like utilities and consumer staples is still underperforming, which also verifies what we've been talking about. Okay, so here's where we think we are. Phase 4 strategy. Okay, ASEAN indices. Okay, today we'd just like to look at Malaysia, and The Malaysian index, we know, same story. We have a very good bull run. We've recently exceeded the all-time highs. Okay, and we note that for a few years now, Malaysia's been trading in essentially a long-term channel like so. Okay, and because you're bullish on Malaysia for fundamental reasons, we believe there are external and internal growth factors. Hence, any meaningful correction should be bought. Okay, we believe a short-term target would be the upper channel at 1940 up here. Okay, but of course, if there's a correction, then this is the support line over here at about 1800, and the bottom of the channel will be essentially a good reward to risk buy point if it ever reaches back there again. Okay, and that will be somewhere around 1750. Okay, we do note that last week we had a slightly bearish candle, so a short retracement will not surprise us. Okay, STI, long-term wise, we have been moving along this long-term trend line, and we have to keep our eyes peeled on this. Okay, we do have a bullish bias due to good fundamentals and relative valuations. Okay, now however, if the price does break down this this long-term multi-year trend line, then that will, we might have to reconsider our thesis. It might imply further downside. Okay, but in the meantime, if we zoom into the chart further, okay, on a short term, we see that there has been a bearish candle, okay, for in combination with a stochastic crossover. So a short-term correction is what we it implies a short-term correction, okay, which is not surprising considering since the last week and the week before we noted that 3170 was a good resistance level, and the price hit there and just correcting off of it. So if this is a bullish retracement, then likely targets would be the 61.8% retracement level here, which is between 3075 and 3085. Okay, so this would be the first retracement support. If that gets exceeded, then you have 3050 to 3025, which is the actual trend line support itself. So in this down cycle, these are your potential targets. So on the longer term, we are bullish, but on the short term, there is weakness going on. Okay, and that's it for the market analysis. I'm going to pass you to Caroline, who will speak to you about OUE.
Hello, morning everyone. This is Caroline. Today I'll be talking about OUE Limited and the potential upcoming OUE commercial rates. I will cover a little bit on this. For OUE, it has actually undergone a transformation of portfolios last year. So before we start, let us have a recap of what has happened to OUE for last year. In June 2013, OUE has acquired the U.S. Bank Tower Class A office building in Los Angeles for Sing$ 495 million. This is the first overseas project for OUE. As per now, it's the only overseas project for now. And in July 2013, they has disposed of the Mandarin Orchard Singapore and Mandarin Gallery to the new launch OUE Hospitality Trust. OUE currently holds about 45.2% stake in the OUE H Trust. In September, they have disposed of two of their overseas China hotels, the Meridius Mandarin Haikou and Shantou. And in November 2013, the first official circular for the proposed divestment of OUE Bayfront properties to OUE commercial REITs was released. In December, they got the approval from the shareholder on this above disposal of the OUE Bayfront properties And what we expect is in the first quarter this year, they are expected to launch the OUE series IPO. The estimated amount to raise is about $700 million. Looking at this slide, this is the current OUE portfolio valuation by sector based on their gross asset value. You can see a large proportion, about 66%, is under commercial, which includes the office and the retail. About 11% is under hospitality, 13% in residential, and the balance 10% in their fund management REITs, which includes the new launch OUEH Trust, the Orchard, Mandarin Orchard, and the Mandarin Gallery. As a start, let us take a look at the Singapore office outlook. For the latest third quarter in 2013, confidence in the office market has improved as there are more listing activities. Although the vacancy in third quarter has increased mainly due to a huge supply of new offices, the Grade A rent remains steady despite of the supply increase. So what we see is this is mainly due to the uptick in the business sentiment in US and the Euro economies upon expectation of US FE tapering. And also a good news is in November, Singapore, the MIT Ministry of Industrial and Trade has actually revised the 2013 GDP growth forecast upwards to 3.5 to 4%, and they expect the momentum to continue to 2014 at the growth rate of 2 to 4%. Okay, these two graphs is actually the office net supply, demand, and the vacancy rate. As I mentioned earlier on, you can see in third quarter there is a huge supply input and the vacancy rate actually goes up. But if you look at the previous one, the rent has actually remained pretty constant. So we feel that this is actually stabilizing and may be sign of that the rent actually still remains, the rental outlook still remains strong in this case. Okay, next main thing is in the coming 2 years, in 2014 and 2015, what we see is there is likely to be a tight office supply in the central area. For the past 5 years, the average annual office space demand is about 1 million square feet. However, in the coming years, the annual office space supply in the central area will only be about 800K, which means that that's likely to remain tight. And the demand, let's say if the demand remains the same and the supply is a little bit shortfall, what we see is the rent will still remain strong in this case. So for our point of view, office rental outlook in 2014 and 2015 to remain cautious positive. We expect them to actually recover slightly with a forecasted growth of about 2 to 4% per annum. This slide actually shows the upcoming office supply in the central area, which includes the core CBD and the fringe CBD. Next, we'll take a look at the Shanghai office outlook. For Shanghai office rental, it has actually appreciated greatly from the mid-2010. In the past year, in 2013, the office rental has more or less stabilized. We see that the listing and inquiries remains low because the local firm and MNC are still pretty conservative over the cost and is holding back the expansion plan. And what we see is in 2013, 2014 to 2016, there will be a huge office supply boom of about 5 million square meter supply into the Shanghai office. However, for now, 70% will likely be in the decentralized area with only 30% in the core CBD district. With the aim of China to develop Shanghai into the major international financial center by 2020, and also the recent establishment of Shanghai Pilot Free Trade Zone, the demand for large office space is likely to predicted to increase significantly over the next few years. So our view is that the rent in Shanghai will likely to decline for near term and will likely to bottom out in 2017 onwards. In long term, Shanghai office outlook still remain robust. Why do we actually talk about Shanghai office outlook is due to the upcoming OUE commercial rates. The preliminary prospectus is not out yet, so we will just cover a brief summary on that. For this OUE commercial rates, the initial portfolio will include the OUE Bayfront and the Lippo Plaza. OUE Limited is likely to hold 40% of the OUE's commercial rates, and they do expect to launch this in the target to launch this in the first quarter of 2014. We estimated OUE will likely receive a net cash proceed of about 300 million Sing dollar from the disposal of OUE Bayfront. There is also a proposed distribution of 1 OUE H trust for every 6 OUE share hold should this OUE series IPO is able to launch successfully. Taking a look, for this slide, it will actually show some of the details for the OUE Bayfront. The latest valuation for OUE Bayfront is estimated to be about $1.01 billion. This OUE Bayfront is located at Collyer Quay Raffles Place. The second property, Lippo Plaza, the latest valuation is estimated to be about Sing dollar 414 million. The location of Lippo Plaza is at Huaihaichong Road, Huangpu, which is one of the core CBD area in Shanghai. In this slide, it will actually shows the potential pipeline for the OUE Commercial Trust in future, which this will include the One Raffles Place Tower 1 and 2 with the retail podium. The second potential pipeline is the OUE Downtown 2 and the Downtown Gallery, and the third one is the US Bank Tower. So in summary, we still prefer, we favor OUE for the above reason. For their rich cash position of estimated about 700 million from the asset monetization, this will put them in a good position in future should they actually would like to take on new project and they are able to have the fund to fund the new project internally. And we also like OUE for their high exposure to the commercial sector. As mentioned, we are quite positive on the outlook, at least for this year and next year on the office outlook. With the new upcoming OUE series launch, OUE aims to expand their fund management business. So we will expect the fund management business to bring in stable and recurring income stream. Should the OUE series pass, the investor can look forward to the possible special stock dividend of this 1 OUE H trust share to every 6 OUE share. This works out to be about 0.145 per OUE share. So in short, the valuation of OUE remains attractive at about, our target price is about 2.82, so the price to NARV discount currently is about 40%. However, we feel that the price upside may be muted for now till the visibility of the capital deployment is much clearer. As per now, OUE has not announced any further plans on what are they going to do with the funds. So we are actually looking forward to the new plans from OUE so that we can have a better outlook on the OUE price movement in future. So thanks. That's all for today. Anybody, now we are open to Q&A. Thanks.
Hi, we have a question for about OCBC's bid for Wing Hang Bank. Okay. Yeah, the newspapers have, well, Bloomberg, has reported that the bid is from their sources looks to be about 1.7 times book, right? And actually, that is an attractive valuation. Originally, the street has estimated that they would likely pay more than 2 times, and if you recall, DBS paid up to 3 times. So at 1.7, it's not a bad price. It's not extremely cheap. It's not, but it's fair. So they do not have to pay a significant premium for it. Now the ROE of Wing Hang is about 9.5, and the ROE of OCBC is about 11. They're both, well, OCBC is trading at about 1.5 times book. It's not far off 1.7. So overall, I think the acquisition price looks to be tilting in OCBC's favor. Now, the only thing outstanding is how will they finance this, and I think hopefully they will not be raising new shares. However, that remains a possibility. So although I would say that the acquisition price looks favorable, please trade with caution because the financing side is not sorted out yet. Thanks. We have asked a question on the target for STI. We don't have a target. What we call is the broad outlook and the trends. Okay, so the STI is for us still in a bull market and still in a continued uptrend. And like we said, we are overweighting the STI because valuations are significantly lower than all other markets. And it is a safe haven, and given the political uncertainties in our region, I think it will be a favored Asia allocation for portfolio managers. Okay, we have questions on OUE. Hold on.
Hello. Okay, we have a question that actually asks that am I correct to say that buying OUE is a kind of buying a company with various REITs but selling at a deep discount? Actually, okay, here you have to understand that OUE is a developer. So for them, they set up the fund management business. One of the is as a way to for the REITs to act as a like vehicle for them to actually unlock the property, should the property at to unlock the value of the properties under the developed properties under their care. So and they only own a certain percentage of the REITs. So it's not really say buying a company with various REITs. It's actually a developer. You have to understand on that. So the price target for OUE as per now, the price target for OUE is about 2.82 for for the next coming 12 months. Remaining as remaining. You mean this one? Or the remaining Hi there.
assets under OUE not monetized, such as US.
Hello. Okay. There is. Okay. The next question is actually what are the remaining assets under OUE without monetized, such as US Bank Tower. Okay. In our slides on page 25, I have actually listed on the included on the properties. So should the OUE Bayfront divestment to OUE C REITs is successful, the remaining properties will be the balance, as you can see in the slides. Okay, there's another question on OUE that says that OUE dropped a lot quite a lot last year. Do you think now it will bottom up and continue to move up? Okay, for now, OUE main thing is as I mentioned earlier. For now, we see that the price upside is muted as the plan is not available on how the companies is going to deploy on their capitals. So we will only be able to give a clearer view on this when the visibility is available. Thanks.
Hi there. Okay, we have a question on Bousted. So whether is it still reasonably priced or good, or should one wait for a correction? In my opinion, Bousted is still reasonably priced despite something like a 65% run-up last year. If valuations are actually about 10 to 11 times PE, which is remarkably low for what are very quality businesses. There is also catalyst going forward in that the industrial portfolio is likely to be REITed, and there is a sizable piece of land in Iskandar to be developed. Okay, so my price target for Bousted is $2.05. I remain positive on the stock, and I think at current valuations, it's fair. It's fair to go in.
There's a question, do I expect a major correction anytime soon for the S&P? Well, as of now, all I can say is there is some evidence of a short-term correction. I can't say that this is a major correction. However, I do expect the odds of a major correction this year is high. It's quite high based on arguments that I gave earlier in the presentation. But I would hesitate to say that the major correction is starting now. Okay, but what I can say is that, okay, I'm going to move the chart back. Okay, so what I can say is this, momentum is slightly turning. Okay, so this means that on the short term, we might be due for a short-term cycle down, okay? But a short-term cycle down will have to negotiate this support zone here, okay? Now, if you get past this, right, then if you get past this, then most likely the next time of the next correction timing in terms of cycle will probably be in May, okay? And May is, there's a good chance that May could be the time of a correction then, okay? And the fact that we have a divergence in the Russell S&P relative strength as well as the divergence in this particular breadth indicator does point to a building up of weakness which could exhibit itself later this year. Okay, so once again, there is some short-term weakness going on now, but I would hesitate to say it's the major correction.
Right, we have questions on the KLCI. So the questions are, do we see any downsides for the KLCI, and whether election outcomes in Indonesia and Thailand may have an effect on the KLCI? Actually, if you look at the KLCI, it is, let me just cycle there, okay. we look at the KLCI, it is not much. Well, we don't have the chart of Thailand and Indonesia here, but we can tell you that the shape of the KLCI almost bears no resemblance to the Indonesian and Thai stock market. In fact, the KLCI is in a different kettle of fish. KLCI and the STI are both actually under the defensive Asia category, right? The KLCI has a lot of, like Singapore, major conglomerates and government-linked companies which are strongly held. The EPF is also a major buyer of the country's stocks, right? So that's why the KLCI behaves quite differently, and also Malaysia does not have the current account weaknesses that have been plaguing Thailand and Indonesia. So it's quite a different kind of index. In terms of downsides for the KLCI, we can't. Well, there's always risk, but at the moment, I think the unquantifiable risks are not really there as they are there for Thailand and Indonesia.
Hi, there's actually a question saying that it seems that Philips is optimistic on office sector. If that is the case, would it be a viable strategy to accumulate office REITs that give approximately 6.5 yield now instead of OUE forecasted dividend at about 2.2%, 2.2% yield? Okay, for I think Mr. Ng, for this, that will have to depend on your strategy. For REITs, usually as if you are going for dividend yield, that will be the REITs yield is definitely higher than the developer. So for OUE, actually, for developer, you are actually looking more on the capital appreciation in this sense. For if you are actually looking for yield, then perhaps you should be looking at REITs instead of developer counters as per now. Thanks. Excuse me.
Hello, Kenneth here again. Okay, question. Hold on. Question. Could you explain one more time on how the S&P is related to Russell? Okay. One way of looking at the Russell is simply this. Now, the Russell is basically a small cap index. A small cap index essentially is more sensitive to economic cycles. It's also more speculative in nature. So basically, investors with a higher risk profile invest in the Russell. So anytime you have a case where the S&P is going up but the Russell is going down, it means that it could potentially mean there is some fear underlying the movement. So even though the S&P is going up, right? I mean, you would assume that when S&P is going up, it's because sentiment is getting better. But if the Russell is not going up along with it, if it's actually not going up as much, right? Then it implies that this increase in price movement, right? The sentiment underlying it may not be as strong as you think it is. So usually when this happens, it gives you a warning to reconsider and to look at the situation more closely, and that's what's happening now. Okay. There's a question on shorting bonds with the TBT. Okay. Now for the TBT, okay, let me just reiterate this. Now, first, this breakage of the long-term trend line confirms to us that yes, bonds have probably started its bear market. Okay, we've been assuming that for a few months, but only this month it's kind of confirmed, right? But to short it now, let's just say this: on a longer-term basis, yes, we believe that bonds is on a bear market. However, on a shorter-term basis, right, the move from all the way from 2000 April 2012 or June 2012, it's been very, very, very extended. So this is a very, very big extended drop in the bond market. So short-term wise, right, we are undecided because it is overstretched. It could easily go back up again, right? But on the long-term wise, we are bearish on it. Can I explain investor intelligence? Okay. Very simple, okay? A survey of financial money managers and analysts in the US, if a survey taken simply says that 4 times as many analysts are bullish on the US market as opposed to bearish. Okay, that's how you get a ratio of 4. So how do we use this? This is a sentiment indicator. It is good to use sentiment indicators when you are at extreme positions. So at this point, we think that this shows that this implies that sentiment in the US is actually quite euphoric. It's quite extreme, and essentially, anytime that this ratio goes above 3, okay, it usually precedes some sort of market correction because everyone's too bullish. So if everyone's too bullish, right, everybody who wanted to buy is bought already. So for the short term, price can only come down. So historically, here are the times where the bull-bear ratio has been 3 or more. Okay, so here is now, and these are the historical times. And if you look closely, each time that this ratio is exceeded 3, it precedes some sort of correction. Whether it could be a small one, could be a more major one, or even a start of a bear market. But there's been some sort of correction. So right now, all I'm saying is that we have that right now. So a correction at this time would not surprise me.
There's a hold on. Alright, there's a question on what's our views on REITs and is it a time to go in or wait? Like I think previously we did discuss the fact that the increase in interest rate has in some ways right now is kind of priced in, and that any further adjustment to it is more of like the changing outlook for interest rate more so than the current projected growth in interest rates already. So, yep. For REITs right now, we feel that the interest rate impact is kind of more or less priced in. However, we do advocate a wait and see attitude first, and to see what's the reaction of how the REITs will perform. Having said that, there are still several companies going to spin off into REITs, some spin off their assets into REITs, and they're kind of a bit bullish on it. Then we do feel that the better way a better way to actually look at the market actually to wait and see, watch for the reaction before actually deliberating on a certain action. So yep, we are definitely advising kind of a wait and see attitude for now. There's a follow-up question, I guess, on asking for our views on CDL Hospitality Trust. We do, the thing about it is for CDL Hospitality Trust, I think for 3Q 2013, their results were actually quite on the downside. They actually reported quite dismay results, and their outlook, the CSO views that they were still facing some challenges. However, having said that, I think 2014 will be a good year for them. They will still continue. Their sector is kind of like having some hype because of the increased number of tourist arrivals and whatnot. So I believe that it will be stable for now. Based on their 3Q earnings, their 4Q is supposed to have a bit uptick, and that is stable for now. That's what I can say. I wouldn't really say that there's very, very huge upside for it right at this point in time, because they're kind of remaining dormant on what they're doing with their assets. So the next question is now a good time to buy capital land.
There's a question on VAT. We don't really cover VAT at the moment, but we see that this company, VAT per se, will have some near-term impact in terms of their execution of orders in the Brazil yacht side. Given that the Brazilian yachts is pretty new, so we expect that the margins there will not be as attractive as before. So investors who would like to go into VAT may have to be a bit cautious for the time being, especially in the short term. But overall, in the mid to long term, this company should be okay.
I'm so sorry about the previous interruption, because the question is, what is our advice on CapitaLand? Right now, as in all three, okay, to address the issue in a more holistic manner, just looking at the big three developers, they're all very undervalued at this point in time because of the residential outlook and whatnot. So in terms of like valuation, in terms of numbers, and the fact that their price is kind of a bit depressed right now, they're all undervalued. However, our advice is still not to go in for CapitaLand or any of the three developers yet, because we are still unsure on the policy front whether there will be new policies coming in. We expect one or two more policy to come in to fine-tune whatever rules that has already been implemented. And so after that, then you may see that there'll be a period of stabilization of the share price before that they will start to have they'll start to go on the uptrend again. So our advice on CapitaLand right now is still to really just stay out first and wait for the more macro news on it. And we expect more policy measures to come out in this H2014. Yep. What's your view on CapitaLand, upside or downside? Once again, I think I've just said it's like on a valuation point of view, all these three developers are all undervalued. So is to answer your question in a very simplistic manner, there is quite a strong upside to it for CapitaLand because of their China residential development segment of their business is doing very, very well. However, having said that, I don't think that is strong enough impetus for their share price to move upwards, because most of the investors are still more worried about the macro outlook for them. And having said that, you can see more and more policies going to be introduced to the fringe tier 1 cities and also to the top tier 2 cities. So these are really the main driver behind their share price movement. So we really have to wait for this to actually have a very good view. And more so than waiting for this to come out, it's more of waiting for such policy fund to cool off, whereby the government start to say that, well, the residential prices are more or less stable. You're going to let the free market movement dictate the price, the capital values of these residential sales. So our view on CapitaLand is, although its valuation wise is still very undervalued, but we still advise to stay out and wait for the policy fund to actually cool off before actually having a very strong buy call on it. So we are still advocating a wait and see attitude for this. Is that all? All right, I believe that is all. Today presenting analyst is Kenneth Cole. So if you have any questions on the different charts, different macro issue, you can actually email him. And the property analyst for our research is right now me, Tan Shijing. You can look for my email tansj@philip.com.sg or Caroline Tay. You can find out both of us on the email, and if there's anything, you should forward your question to us. And I hope that we have adequately answered the question, and we will be willing to answer any further if there is. All right, and I guess that is it. We hope that you can tune in next week, and that's all. Thank you all for tuning in this week. just click send to.